Welcome back, you legends. I'm Dr. Cal, and I got an epic one for you tonight. So please stick around to the end of the video and let's get right into it. 7 stocks are responsible for 83% of the S&P 500 returns year to date. And what do you notice? What's in common with all of these stocks? Apple, Microsoft, Nvidia, Meta, Tesla, Amazon, and Google. We'll get right back into this, but let's start with the S&P 500 performance on Friday. The S&P opened flat, rallied, then dumped immediately all the way to the middle of the day. Then it had a meager recovery towards the end of the day. The S&P closed 0.2% down, the NASDAQ 0.35%, and the Dow Jones 0.42%. Let's take a look at the different indices. Financials did well. They led the day. And this is not a surprise, guys. Big banks were set to report on Friday. And just a day before, I said that I expect big banks to report really good earnings. And that's for a myriad of reasons that I explained in the last video. Please check that last video out if you missed it. So banks led, followed by communication services and energy, then real estate, utilities, basic materials all lagged. This is not a clear-cut, guys, differential between the risk-on, risk-off sectors. It's a bit of a weird mix, and it's very likely because of those mixed results between UNH, right, United Healthcare doing very badly after its report, while JPM, Bank of America, and Citigroup doing well after gaining all of those deposits from the dying regional and smaller banks due to the SVB collapse fiasco. Now, I want to start with the JPM earnings report. As you'd expect, the weakness of the smaller banks was a huge boom for the big banks. And what's the biggest of them all? The laundromat, as Maverick likes to say. And that's JPM. JPM did amazingly well. And again, that's not a surprise. JPM has been doing this systematically in its last 4 earnings reports. It has been doing this. It's been ripping, and ripping on each one of those earnings reports. And this was a fairly easy one to read. We had a double bottom with 2 tweezers at the low, and the second low being a higher low with the PPO improving consistently. And we had the fundamentals supporting this trade as well. Now, I posted a note in the Money Time Machine trading community a day before JPM reported. JPM is set to report earnings tomorrow before the market open. The expected move is $4. In either direction, we got a 2 sigma move, so we got double the expected move. The stock is printing a hammer candle today, and the PPO continues to improve. In the previous 3 earnings reports, the stock either gapped down and rallied or gapped up. So in all cases, it rallied. In some cases, it gapped down, then it rallied. In other cases, it just ripped right off the bat. The demise of the smaller banks has been without a doubt a huge benefit to JPM, so I favored the bulls here. Now, if you were brave enough to take a 0-date option trade in JPM, a lotto ticket, you would have made 1,400% on this trade. The $135 calls a day before the company reported earnings were at 26 cents, and the stock closed at 138. So those calls closed the day at $3.78. That means if you put in $280, you would have made $3,780. If you put in $2,000, you would have made over $37,000. Absolutely nuts. Obviously, this is a gamble, right? If you trade earnings, unless you have a very clear edge and unless you control your position size, control your risk through your position size, I do not really condone this kind of thing unless, again, you have an edge, a fundamental edge, an informational edge, and on top of that, you control your risk through small position sizing. If you took this trade, congratulations. That's kind of insane. 1,400%. Congratulations. That was an amazing trade. By the way, guys, I post these kinds of trade setups all the time in the trade setups section in the Money Time Machine Discord community. Check out the link in the description below if you're interested in keeping up to date with all of my analysis work, my trade setups, my weekly watch list. All of the charts that you see in the daily videos and the weekly videos have everything set up in the My Charts section. And obviously I post my daily market analysis in live analysis. Again, check out the link in the description if you want to support this channel and you want to keep up to date with all of my work. The community continues to rapidly grow, and I thank every single one of you for making this dream possible for me to share my journey with everybody. So thank you so much, guys. And obviously, guys, if you just enjoy the videos and you do not want to join the community, that's totally fine. You can also support me on YouTube just by smashing that like button totally for free. Thank you so much, guys. Now, I want to start this video out with a lot of data, fundamental data, before I get into the charts. And this is the kind of stuff that really drives markets. So please, guys, if anything, focus really hard on this next bit because you're going to learn so much. So let's start out with institutional money market assets. Down below, guys, is money market assets. Money market funds, guys, are funds that are basically equivalent to cash, but with a very high interest rate return that is very close to the federal funds rate return. So instead of putting your money in a savings account in some bank with some really pathetic interest rate returns, you can take your money, put it in a money market fund, and you can make significantly higher returns. And that's exactly what big money has been doing. And notice this pattern, guys. In 2000 to 2003, money really accelerated into money market funds as money exited the S&P 500. The exact same thing happened in 2008 as money came flooding out of the stock market due to the heightened financial risk. It came running into money market funds. Same thing happened in 2020, and the same thing is happening again right now. This chart shows how money market fund flow began to tick up as early as February of 2021. Here's an updated picture, guys. This is an updated picture of what's happening. Look at this. Record $5.1 trillion into money market funds. A huge acceleration in recent years. A huge re-acceleration now as we get closer and closer into recession. The same thing happened between 2007 and 2008 before the recession, and then we had a re-acceleration as we got deep and deep into the 2008 recession. Now here's another look from Eric Balkanis. This chart of money market mutual fund assets is breathtaking. It's not just the angle of the slope. Yeah, it's vertical, guys. This is going straight up to the moon. But the size too. They've grown by $460 billion just this year. Just the last 3.5 months. Okay? That's 6 times what all of the ETFs combined have taken in. Now, please try to wrap your head around this. The entirety of the ETF ecosystem that include the S&P 500, the NASDAQ 100, so the SPY, the Triple Qs, the IWM, the Russell 2000, the global ETFs, really everything has seen less than 1/6 of fund flows versus the money market funds. So big money is exiting the stock market at lightning speed, Look at this. It's absolutely vertical, absolutely nuts. I mean, we haven't seen anything like this for ages and ages and ages. Now, worse yet, what is smart money doing? Smart money has actually been accumulating some S&P 500 positions as the market was finding that low earlier in March. And they have actually been dumping recently. They started dumping a week ago as the dumb money has begun buying in. So that's what the smart money does, guys. They buy low, then they begin to dump into the dumb money after the move has already begun to peak. And that's what's been happening. Notice at the intersection between the smart money declining, the dumb money climbing up. The intersection usually marks the stock market top. The intersection usually marks the stock market top. The intersection usually marks the stock market top. And yet again, we are getting one more intersection here where dumb money is accelerating, and smart money is actually reducing S&P 500 exposure. Now let's talk about deposits in banks. This is an absolutely breathtaking chart. A straight 45-degree angle, almost entirely uninterrupted for over 20 years, until very recently. Notice how bank deposits have been drying up at an insane rate. Look at this. $500 billion left banks just in the last month and a half. Just since the SVB debacle, $500 billion exited banks. And where did it go? Where did that money go? Well, if we go back to our handy chart, they've been exiting the market, they've been exiting banks and going into money market funds. They've been going into money market funds. They've been running to safety. Now, what's more, guys, is the Fed balance sheet. The Fed has now been tightening monetary policy and reducing its balance sheet for over a year. Recently, we had a spike in the Fed balance sheet as it took all of those distressed assets off the smaller banks' balance sheets recently after the SVB collapse and the run on the banks. And we saw the spike, and we're now seeing the balance sheet getting reduced rapidly yet again. So all of that liquidity that drove the market up in the last 4 weeks precisely is now drying up. We're seeing money exit into money market funds. We're seeing the Fed balance sheet drying up, and we're seeing other major warning signs that I'll talk about in just a bit. Including this, I can't remember the last time I've seen something this insane. We've seen companies going bankrupt at an insane rate 4 straight months in a row, 50, 54, 58, 71, and continuing to rise. Do you expect this number to go down or to go up? Based on everything we've seen so far, based on what the Fed has been doing with interest rates throughout the last 12 months, based on the inverted yield curve, based on money leaving banks, based on money flowing to money market funds, what do you think is going to happen? This is going to continue to rise and will almost certainly outrun even the 2020 pandemic bankruptcies. More and more institutions just cannot bear interest rates staying this high for this long. They've been addicted to free money, absolutely free money for years and years and years. The economy was addicted to free money. The economy was hooked. It was an absolute disease of free money. Now that the situation is actually returning to what is somewhat of a normal state, we're seeing the economy not be able to keep up and companies going bust left and right, including really big banks like SVB, which was in the top 20 largest banks in the US just before it collapsed. Now, 7 stocks are responsible for 83% of the S&P 500 returns. Now, all of these 7 stocks, not only are they all tech stocks, but they're all tech stocks that got beat up throughout the 2022 bear market. And so we had this somewhat of a short covering rally, short squeeze going back into the beat up sectors of the market. But now that we've already seen the rally in the S&P, and with the exodus out of the market accelerating, you will see the pendulum swing violently the other way, with all of these stocks poised for significant sell-offs coming up in the next quarter. Now, what's also in common with all of these stocks is that pretty much, guys, every single one of them is topping. Pretty much every single one of them has already topped or is topping. That includes Apple, Microsoft, Nvidia, Meta, Tesla, Amazon, and Google. Every single one of these guys. And I'm going to go through some of these later in the video, so please stick around so you can see what is exactly happening and how all of these companies that led the market are now getting to roll over. And when they're responsible for 83% of the S&P 500 returns, what do you expect is going to happen when all of these begin to roll over? We'll see the same percentage, but instead of returns, we'll see losses. They'll be responsible for 83% of S&P 500 losses. Now that brings us to stock market breadth. This is the S&P 500% of stocks trading above their 200-day moving average. And what do you notice, guys? The S&P down below has been making higher highs as breadth has been struggling to take out the March high. This is a major negative divergence where breadth has been unable to keep up. And that reflects that 83% figure that we just seen. That's because, guys, all of this rally that we've seen recently, it's just been led by a handful of stocks. And they're pretty much all topping as we speak. And so we can expect breadth to begin rolling over as the S&P finds a top here very soon. If we take a look at an even wider measure, this looks at the entire stock market, not just the S&P 500. It's even worse. Breadth is way worse. Look at this enormous negative divergence. Breadth has been collapsing as the S&P 500 has been sucking in dumb money while smart money has been dumping positions and exiting the market at light speed, the fastest rate we've seen really since the beginning of this bear market. So just beware, this screams a huge trap, especially for retail traders that like to get in a little bit later. And unfortunately, it's the smaller traders that will be left holding the bag as these big institutions continue to discreetly unload positions. Now, I haven't talked about this indicator for a long while. This is the Money Time Machine Imminent Doom indicator. And I talked about this indicator last year, and I talked about one very specific signal that I've been waiting for months and months and months. This signal has triggered. This signal has finally triggered this month. And it's the PPO crossing over, producing a bullish crossover in the TLT divided by the SPY ratio. This is the ratio between the Treasury, long-term Treasury notes, and the S&P 500. Why is this the imminent doom indicator? Well, what happens just before a huge market collapse? We see money exit the S&P 500 and run to safety. Safety being either cash or cash equivalents or risk-free assets like long-term treasuries. And by risk-free, we're talking about risk of default, not interest rate risk. So money exits the S&P at record rates and it floods into the TLT. And the first sign of that happening is the PPO producing a bullish crossover. Now, I marked every single time this has happened since 2007. These two vertical red lines represent the only times this has happened when the yield curve was in inversion. The vertical orange lines, these dashed lines, represent every other time that this has happened, but without a yield inversion. And in all cases, without exception, this has led to market weakness either immediately or soon thereafter. The double dip economic slowdown of 2015 and 2016, the 2008 China trade war, just before the 2020 crash, and right here at the 2010 to 2011 mini recession, and just before the 2008 major recession and financial crisis. Now, again, the difference between these dashed lines and these vertical red lines is that these two examples, we have yield curve inversion. And when we have yield curve inversion and then we begin to see money flow out of the S&P and into the TLT represented by the first bullish crossover on this ratio chart, that represents money exiting the market and running to safety ahead of a major economic calamity. Now let's talk about another sign of smart money not being as excited as the stock market appears to be. Now up top, guys, is HYG, the junk bonds, high yield bonds. This is where smart money floods when it wants to take risk, when it thinks that the economic conditions are improving. When a smart money is bullish, it buys high yield bonds because, guys, the bond market is way larger than the stock market. And when bond traders want to take on risk, this is where they go. They go into high yield bonds. What do you notice? High yield bonds. Now, 3 consecutive sessions, the S&P has been taking out this prior high in April, early April, while the smart money high yield bonds has failed every single time to take out this prior high. This is a major negative divergence, what we call a negative divergence. We've seen similar negative divergences mark prior stock market tops, including this top where the high yield bonds were dumping. The S&P was trying to rally. Again, high yield bonds breaking key support while the S&P 500 was appearing to consolidate, while in fact it was distributing. The difference between distribution, guys, and consolidation is that consolidation is tightening of the trading range as bulls accumulate positions, while distribution is tightening of the trading range while bulls sell positions, while they exit positions and take profit in preparation for the next down leg in the market. Now let's take a look at the VIX. There's no way to sugarcoat that. The VIX looks horrific. The VIX looks absolutely ugly. Absolutely ugly. The VIX is back now at the same level that we saw exactly at the February top and almost exactly at the January high, just slightly above the January high. And the January high, guys, was the S&P 500 top before the bear market started. So we're back, almost back, the same level of complacency. Now low VIX, guys, means complacency, means the market thinks that it's going to go up forever and ever and ever. No need to manage risks. Just go crazy and buy everything. Because, guys, again, the VIX measures volatility, and the way it does that is that it looks at option premiums. Now a lot of very smart people have actually been saying that, okay, maybe the VIX is broken because of the 0-day options. I don't entirely agree with that. I think that 0-day options have actually muddied the water for sure. They have muddied the water. But what they actually did, they did not really break the VIX. What they actually did was they made complacency even worse. They made rates of complacency way worse, because instead of having to trade options that are a month out, 2 months out, 3 months out to hedge your position, we're now seeing the majority of trading, 60% of option trading, going into options that expire on the exact same day. Now, that's what we call 100% what? 100% what? Speculation gambling. That's gambling behavior. That's 100% speculation, unless you have some sort of edge, some sort of secret knowledge that nobody has, unless you have some insider information. Otherwise, there's no way to justify 60% of the trading volume going into options that expire the same day. Keep in mind, guys, that the vast majority of same day expiration options expire worthless. $0. They expire at zero. So it's the dealer raking in the profits from all of these gamblers. And that makes the market that much more dangerous. Can the VIX go lower? Yes. Can the VIX go lower and the S&P continue to rally? Yes. Can this go on for a long time? No, it cannot go on for a long time. The VIX has been an absolutely a gem of an indicator to really have one simple indicator to give you an idea of whether the market is overvalued or undervalued in the medium term, right? When the VIX is rising and peaking, it marks stock market bottoms. And I'm going to show you a lot of these examples, guys. When the VIX is rising and peaking, it marks stock market bottoms. When it's rising and peaking, stock market bottom, rising and peaking, stock market bottom, rising and peaking, stock market bottom, boom, stock market bottom. When it's declining and bottoming, stock market top, stock market top, stock market top, and stock market top, very likely developing as we speak. The rational conclusion and the logical conclusion is that the VIX should rise as we get deeper and deeper into the earnings season. Why? Well, because we have so many unknowns, so many question marks about company earnings, about the economy slowing down, so a lot of uncertainty. And when uncertainty builds up and builds up and builds up, you see the VIX explode. It doesn't have to be bad news, guys. The mere existence of uncertainty drives the VIX higher. The mere presence of uncertainty drives the stock market lower. The market does not hate anything as much as it hates uncertainty. The VIX is now very likely beginning a major bottoming process. And again, as we enter the earnings season, we can expect logically, rationally that the VIX hedging uncertainty will continue to grow as some of those earnings bombs begin to drop. I want to talk about a number of sell signals, major sell signals that I covered in the trading community. Again, guys, link in the description below if you want to get up-to-date signals, live analysis, and trade setups. Check it out, our Patreon page. Now, above is the 10-year yield, this chart above in the green and red, and below that is the S&P 500. And what I did is that I marked pretty much every single time the 10-year yield has crossed above the 20-day moving average. And bad things happen. Every single time, guys, bad things happen. Every single time yields have broken out throughout the bear market, bad things have happened. And so far, we have had 3 major sell signals develop. The 10-year yield signal that I'm going to share with you in a second. The high yield bonds putting in that major divergence that I talked about. The VIX showing extreme rates of complacency. Money market funds seeing major record inflows. Breadth continuing to show negative divergences. Other divergences like the Dow Transports and the Dow Industrials showing major negative divergences. So many things are happening, guys, that are warning the market is now topping. Big money is dumping. Just be very careful. Be very careful. Please manage your risk. Please be aware what the smart money is doing, what the big money is doing. And what the big money does is what the S&P 500 ends up doing. This is the 10-year yield. This dark red line is the 20-day moving average. Every single time we had a breakout, we had the S&P 500 see significant weakness follow. Every single time we had a breakout, we had significant weakness follow. Again, guys, every single time we had that breakout, we had significant weakness follow in the S&P 500. Now, the caveat here, guys, is that you need a break above the 20-day moving average and a bullish crossover, and we got both. We got both. So we got confirmation that, yes, yields are breaking out. The S&P 500 is beginning a major weakening process, a major topping process, and is about to see significant selling to the downside. This doesn't mean that the S&P cannot rise for the next handful of days. It can absolutely continue to rise for the next handful of days. But what it means is that big money will be selling, and unfortunately, small traders and fast in and out money will be buying at the wrong time, unfortunately. Let's take a look at the dollar index. I again marked the last time the dollar index has put in a low, a major low. And by that, I mean, guys, a new low on the chart with a very bullish green candle closing in the green. So notice this is the lowest point of trade throughout this downtrend. Then we closed with a huge green bar, and that marked the bottom in the dollar index and the top in the S&P. We had the same thing happen Friday, a new low on the DXY with a huge recovery. And now the question is this going to be the top in the S&P? And the answer is this next little few sessions, we are likely going to see the top in the S&P. Confirmation signals are going to be bearish cross downs on the summation index and a breakout in the VIX. Those haven't happened yet, so it's not yet the time to go aggressive. It's time to look at taking profit, at least in the indices, managing risk, potentially opening hedges, potentially scaling in some hedges and short positions. That's what these technical signals mean essentially. The time to go absolutely ham would be after the VIX sees a real sustainable breakout. Let's talk about the fear and greed index. We had a reading of 69 last Thursday, and I went and marked every time the fear and greed index marked the 69 level. And it happened in November and again in January, and I marked it right here. And it marked, guys, the last leg of the rally. One final leg up, one final leg up, and that was the top. That was the top. Now, assuming that we do get one final leg up, and then we see fear and greed hit the 75 greed reading, and we see things like the summation index beginning to slow down and the VIX rising, that would be the ultimate signal to really run from the markets. This is the daily chart for the S&P 500. Let's take a look. We had a doji indecision candle with a red small body. An indecision candle, guys, usually marks the end of a trend. When it comes at the bottom of a trend, it usually marks a reversal to the upside. When it comes at the top of a trend, it usually marks a reversal to the downside, right? At the bottom of a trend, reversal to the upside. At the top of a trend, a reversal to the downside. And we're now beginning to see more and more of these small dojis. What it essentially means in terms of stock market psychology is that the market is less and less sure about the market continuing to rise. It's bulls losing conviction every time you see this indecision candle. And so we can expect two things out of these kinds of indecision candles. Usually you get one of two things. You either get one really massive melt up on a top. The other one, guys, is that you get a second close, a close below the close of Friday. That would be a confirmation candle, and you would get a massive sell-off after that. That's when I expect these gaps to be filled below all the way to 401 at least back to $400 level to retest the 50-day moving average right here. We have 4 gaps left behind. Gap 1, gap 2, 3, and 4. And 4 is pushing it pretty hard, guys. 4 is way too many gaps to leave behind without a pullback. So at this point in time, I would favor a pullback, fill these gaps, one more melt up and a top. If the market continues to ignore these gaps below and continues to melt to the upside, the reaction to the downside is only going to get much more violent. The more you stretch the rubber band to one direction, the more it snaps back with a vengeance in the other direction. And so for the bullish case, for a healthy rally to fill the gaps below and then continue to move up to finish the 3 drives at a high scenario that I talked about ad nauseum, that would be my preferred scenario. If we instead get a melt up, that would unfortunately only bring the top sooner, right? Instead of topping, let's say, a couple of weeks from now, if we get a quick melt up right now, that would unfortunately bring the final top just sooner. Now let's take a look at the NASDAQ. The NASDAQ did have a bearish PPO cross down. 3 trading sessions ago, we had a break of the RSI below its moving average and a back test and a rejection. This rejection needs confirmation. We need to see the NASDAQ close below the body of the last candle, the Friday candle. Otherwise, we will see a continuation move. If we get a close above this indecision candle, we will see a continuation move to the upside. On the other hand, if we get a close below this indecision candle, we will likely get a decision made to the downside, and we will move to fill the gaps below, and the NASDAQ will likely tag the 50-day and the support line of this ascending wedge before it very likely continues to rally to realize its full measured move, which I talked about ad nauseum again in previous videos, at 332 to fill this gap. Now, this is the full measured move. You extrapolate the full measured move from this double bottom. It's the distance from the double bottom to the neckline. And if you double that distance, you get an exact, to the penny. I mean, there's no way on earth that this is a coincidence. An exact to the penny gap fill of this gap left by the NASDAQ back in August. So again, I favor right now, pull back, fill the gaps below, move higher again, put in the final top where all the indices top, and then we get continuation of the selling. Now let's talk about the Dow Jones. The Dow Jones broke above this major resistance line. It broke above it on Thursday. It retraced back on Friday, but it stayed above it. It remained above it. It closed 2 days in a row above it. It would favor the Dow Jones outperforming the S&P and the triple Qs. And you can see that reflected in the PPO. You can see the PPO continuing to be green and rising while the NASDAQ has a bearish crossover and it's now rolling over. Let's take a look at the SPY 1 hour chart. This is a live chart that I share with the trading community every single day. And we are now back at support. We have held support so far. This pale gray line is the 5-day moving average. We have continued to hold above it. If we close below it at any given time and take out this ascending channel, we will see very likely a full measured move all the way down to fill the gaps below at 403, then at 401. So now I'm watching this divergence right here. slightly higher high, lower high on the stochastic. We have a bearish cross down on the stochastic. We are still holding these support lines. So again, bears do not yet have control. They will only gain control again if they break below this ascending channel. We get the first close below the ascending channel and below the 5-day moving average. That would initiate that pullback to fill the gaps below. ES, the S&P 500 futures, what do we have here? We are still trading within a range, and this to my eye looks like one nasty Wyckoff distribution pattern, right? Double top, get the VT, the capitulation move, a break above the previous resistance, then immediate rejection, and then you get the back test at the previous levels of resistance. If we get rejection here at these previous levels of resistance, again, boom goes the dynamite, we go down, we fill the gaps below. Let's talk about TLT. TLT has now produced a bearish cross down as the 10-year yield has been rising. And again, when TLT has put in this double top, usually the S&P has topped. I talked about this previously. Again, double top, we get the S&P 500 topping. Now let's talk about those stocks that have led the market, the 7 stocks that were responsible for 83% of the returns in the S&P 500 year to date. One of them is Alphabet, Google. What is Google doing? Google is stopping. Google is hitting our major resistance level, the upper edge of this ascending channel. Perfect ascending channel, respected every time this year. And I do not expect this to change at all. I mean, just look at the PPO, look at momentum. It's been slowing down significantly, putting in the first negative divergence here where the price action had a higher high. PPO produced a lower high. The second step in this topping process is producing an equal high to the last high with another negative divergence. It has done so. Now we can expect one final boom, gravestone doji, rejection, and sell-off. Probably, guys, first to fill the gaps below to the 200-day moving average, maybe one final attempt, and then we go back to the bottom of the ascending channel. Let's take a look at Microsoft. Boom, again, Microsoft very close to fulfilling its full measured move at 295. PPO has already produced a bearish crossover 4 days ago. It continues to underperform the NASDAQ. PPO continues to turn down. The histogram continues to print red candles. Again, Microsoft topping. Apple, again, a bearish crossover 4 days ago, a double top with a negative divergence on the daily chart. Looks extremely bearish here, guys. A full measured move down to 155, very likely coming in very soon to backtest these prior levels of support. A key pivot zone. Watch this. Market on your chart, 155 on Apple. Let's take a look at the New York Stock Exchange McClellan Summation Index. Here it is. We have so many negative divergences here. This is the first negative divergence. Here it is. The oscillator putting in a lower high. We have another negative divergence, an intraday high, and a lower high on the oscillator. Again, I favor pullback here before we continue higher. Ultimately, that would actually be healthier for this rally and will allow it to continue for longer. NASDAQ Summation Index, very weak, way weaker than the New York Stock Exchange. NASDAQ Composite failed to take out the prior high as the S&P has succeeded at taking out the prior high. The advanced decline line continues to decline throughout this rally. Again, guys, bearish signals all over here. And oscillator very weak, just about to produce a bearish cross down. Let's take a look at the gold standard money time machine put to call ratio buy and sell signal. This is our very own buy and sell signal. You will not find this signal anywhere. This is my own take on the signal. And so far, guys, this signal has been pretty much flawless. It's lagging. It is a slightly lagging signal, but so far it's been flawless. Case in point, we get a bearish cross after the 5-day moving average has hit the 1.115 level. If we get a bearish cross on the PPO, that marks a bottom. If again 1.15, we get a bearish cross, that marks a bottom. Yet again, we get that 1.15 go down, bearish cross, we get a buy signal. A sell signal is the opposite. We get a cross below 0.8, then we get a bearish cross, confirms a sell signal. So the horizontal lines represent the real-time buy and sell signals, and the PPO crossovers represent the confirmation signals. So these are the real-time signals and these are the confirmation signals. So far, we do not have either the real-time or the confirmation signal to confirm a sell signal. Sometimes, guys, we get a sell signal without the 5-day moving average dipping below 0.8. As long as the PPO produces a crossover, that produces a sell signal and the market tops. So again, to summarize, we need two conditions. Condition one, we need the 5-day moving average to have reached the 1.15 level. Then we need the PPO to cross down. That produces a buy signal. Again, cross down below 1.15, buy signal. Again, cross down, comes back from 1.15, buy signal. The sell signal, guys, we need to see two conditions. Condition one is that we need to see the 5-day moving average come down to the 0.8 level. That is the real-time sell signal, the real-time sell signal, the real-time sell signal. And then if we get a cross up, that confirms the signal. If we get a cross up, that confirms the signal. If we get a cross up, that confirms the signal. In this example, guys, this top, we did not actually get a reading of 0.8. We did not get that low, but we did get a confirmation signal by the PPO crossing over just before the market tops. And so sometimes we get the confirmation signal without the early signal. That would still be as good of a sell signal as a one without the early sell signal. The advantage of the early signals, obviously, is that you can get in early. That's the real advantage. Now, let's take a look at the economic events this week. New York Empire State Manufacturing Index. Tuesday, building permits. Wednesday, not much going on. Thursday, initial jobless claims. Friday, S&P 500 manufacturing PMI flash. So what's going to drive the market this week, guys? It's going to be earnings. We have a lot of earnings. So many banks, small banks reporting, as well as some tech companies like Netflix, ASML, Tesla, IBM, Lam Research, TSMC, Seagate, and more. The ones that I'll be watching, guys, are going to be Netflix, because that's going to gauge the spending power of the American consumer. Then I'm going to watch ESML, IBM, Lam Research, Tesla, TSMC, and Seagate. These are going to give us key insights as cyclical names. Some of these are hyper cyclical names into how fast the economy is slowing. If we see Lam Research, ASML, TSMC, Seagate all seeing sales slow down, that will be a major warning sign. Again, if we see Tesla seeing sales come down, that will be a major warning sign that the economy is indeed drifting into recession. Thank you so much, guys, for watching till the end. I really appreciate the legends that watch the entire video. Massive thumbs up to you. If you want to support the channel for totally free, all you need to do, just slap that thumbs up button for me. I would really appreciate it. If you watched the video till the end and you did not enjoy it, I thank you and I appreciate your time. That's all I have for today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.